Thank you for joining us today for our Lunch and Learn seminar program. My name is Bill Sadler, and I'm the chairman of the Albany Area Chamber of Commerce Small Business Resource Committee. This week is National Celebration of Small Business Appreciation Week across the country, celebrating small business owners all across our nation. In the Albany Area Chamber of Commerce, small businesses make up about 90% or a little more of our membership. And also, small businesses have a very large impact on our local economy. Well, we're all very busy these days, and many of us simply don't have time to further our knowledge in areas outside our profession. For this reason, the Albany Area Chamber of Commerce has devoted this week to launch a new training program to serve our business community. Today's Lunch and Learn is being filmed and will be made available via the Albany Technical College and the Albany Area Chamber of Commerce. More training videos will be made available in the near future. In fact, the Chamber would greatly appreciate your suggestions for future training topics. A special thank you goes to Albany Technical College for use of their facilities today, as well as the video production of today's seminar. Albany Technical College is providing their services and facilities free of charge in support of the Chamber members and our local business community. Matt Trice is Vice President of Economic Development at Albany Technical College. Matt, will you please share a few words on behalf of the school?
Sure, be glad to, Joe. Thank you very much. Albany Tech is glad to have you here, and we're glad to have those who view us on the web with us as well. You mentioned that 90% of your members are small business, and the majority of businesses in our community and in our service delivery area are in fact small business. And we are here not only in those traditional senses that you know Albany Tech has, but we're also here on a consulting basis to small business. And we'd like to offer that service to the community through the Chamber to your memberships, and we look forward to doing so. We look forward to being a part of the success of the small business community here in Albany and Garden County. Thank you.
Thank you, Matt. Today's presenter is Miles Espy, who is the 2012 Chairman of the Albany Area Chamber's Board of Directors, and he's also a partner with Drafford & Tucker accounting firm. Miles has been with the firm since 1991, and today he oversees the firm's tax department with specialties in tax and audit services. Today's topic is about choosing the right business entity, and the title is, I'm a what? How to choose the business entity that's right for you. Thank you, Miles, for your leadership in the Albany Area Chamber of Commerce and for presenting our Lunch and Learn seminar today.
Thank you, Bill, very much. Again, once again, we'd like to thank the Albany Area Chamber of Commerce and Albany Tech for your many contributions to not only our community, but our business community. The Chamber, as Bill mentioned, is composed of a lot of small businesses, so it's important that we have this week set aside to recognize them. There are a number of things that the Chamber does to serve our area of businesses, and I want to commend Bill in particular as the chair of the small business division for taking the initiative to add even more value what our Chamber provides membership, to add more value to small businesses. So again, thanks to you, Bill, and thanks to Albany Tech very much. One point of order before we begin talking about types of business entities and what might be the best option for your business. A point of order that I'd like to just let everybody know as we go through this, if a question comes to your mind, I'm speaking accounting talk, some things I'm used to talking about all the time. And so if there's something you're not sure about, what I mean or what I'm referring to, please feel free to interject with any questions or comments that you might have. Odds are if you have that question, somebody else in this room or somebody watching the broadcast over the internet may have the same question. So if a question that you ask might tend to take us off the beaten path, I'll ask you to hold that question until the end of the session where we have a little bit of Q&A time built in here. But again, I'm talking about how to make the proper choice for your business as far as the entity is concerned. What's really right for your business? And it's a very important decision that any new business is going to face, is what business entity is best for me. there are generally 5 types of business entities that can be used for establishing your business. However, there are also a number of issues that need to be considered when selecting the appropriate business entity for you. These issues can be complicated, so it's very important to have proper legal and tax consultation before you select one. And you may be saying to yourself, well, you know, Miles, we need proper tax advice. What am I getting out of sitting through this course and hearing about these types of businesses? Should I just wait and ask my tax professional or my lawyer as I consider these options? If you go ahead now and you gain a little bit of knowledge on these different types of business entities, it will help you along the way. It will further you in your decision. You're likely to spend less time with your CPA or with your attorney that you're talking with because you have a good idea of what you probably need to be anyway. And so that'll help keep your fees down as well. So what I see a lot of times very frequently is persons will start a business and they're really gung-ho about what they're doing. They're really excited about the product they're going to manufacture or sell or the service they're going to provide. And really how they're going to operate the entity that's going to house the business is really almost an afterthought. They're so eager to do what they love to do. And many times I see they will move forward with something, not really give proper consideration, and then have some significant issues develop, whether they're tax issues or liability issues, things of that nature. So if you find yourself in that situation, if you've already selected your business entity, and you've already been operating as a business for a number of years, you know, and you see something today that's indicative that another business entity might be a better choice for you, feel free to give some consideration to that, because it may not be too costly, depending upon the facts and circumstances, but it may not be too costly for you to make a conversion to an entity that might be a slightly better choice for you. But as I said, there are really 5 primary types of business entities. The first one is a sole proprietorship. And you have a partnership, a corporation, an S corporation, and a limited liability company. Many of you, I'm sure, have heard of these types of entities and may know quite a bit about them already. And it would be real easy for us to just kind of dive in and start talking about them. But before we really talk about these entities, we need to take a moment and consider what factors go into selecting these. All of these entities have different attributes that some may make them attractive for what we're doing and some may be not so attractive. So we're going to talk a little bit about the factors that should be considered. Now here, you'll notice that I've indicated that the factors here, these are just some of the factors to consider. The different issues that a business could be considering are really so numerous, and the different facts and circumstances can be so numerous it's impossible for us to talk about all the different considerations that would need to be taken into place. That's why you do need ultimately to sit down with a professional and go through your facts and circumstances. But I've listed here our primary ones that we tend to hear more about, and you'll notice here that this first column here, as we go through it, you'll notice this first column really has nothing to do with taxes whatsoever. This next column tends to be more of the issues related to taxes. Most people think when they're selecting a business entity, they put taxes on the forefront. How am I going to be taxed? What's the most tax efficient way for us to operate? There are a number of other considerations that may be more important than taxes that need to be considered. So we'll walk through some of these and chat about these as well. The first item here is one or multiple owners. Many businesses require multiple owners, and there's some options out there where you cannot have one owner of a business, like a partnership, for instance. There cannot be one partner in a partnership by definition. You've got the capitalization of the business is very important. What I'm referring to there is the money for operations. When you're setting up a business, how is it going to be funded? How much debt is going to be out there? How much are your investors looking to put into the company? After your investors put those funds into the company, are they going to have a need to pull those funds out in a fairly short period of time. All those things can be different factors that help you select the right business entity that might allow you to accomplish the goals that you're looking at there. This next one is maybe the most important one of all, personal liability protection. If I go out and I set up a business and I incur debt, or there's a claim against me for services I've provided, or something of that nature, I want to probably protect myself and my family's assets as best as I can. And so having the proper structure will allow you to have more preservation of your personal assets in setting up your business entity. Next, we have control of the business. Very important. We may have a number of different investors, but we may want to have control with just a few individuals that are operating the business on a day-to-day basis. And again, your entity selection can have a huge say in that. Future sales of interest to raise capital. If you believe, well, I'm going to start out my small business and I believe my business may be growing, and I envision in my long-term plan, I'm going to need more capital infusion, and that type of thing, you have to make sure you've got a structure in your business that will accommodate that additional capital infusion the way you have planned for it. And we'll talk about some of those structures that allow for that in just a moment. The organizational costs can be a factor as well. You know, somebody that's starting a business on a shoestring budget. You know, many small businesses start out, many fine businesses start out in somebody's garage or a home office. And so they have limited resources to put into the business. So the cost of organizing can be a deterrent as well. I mean, like I said earlier, a lot of these considerations that are on the right-hand column are related to taxes. You've got very basic income taxation. Who pays the taxes? Does my business pay the taxes? Do I pay them personally? How does that transpire? Another item that may be important to a business may be the method of accounting that they want to use. The two most basic methods of accounting are the cash basis method of accounting and the accrual basis method of accounting. Under the cash basis method of accounting, you're recognizing income as you receive the cash itself. So if somebody owes you funds that right now are presently in accounts receivable, you haven't actually received the cash yet, it's not part of your taxable income. By the same token, your expenses are on a cash basis as well. You're allowed to get deductions for them as you pay them out. If you just said incurred the liability but you haven't paid it yet, you don't get the deduction for it. That's the typical cash basis. Accrual basis, you recognize income as it's earned, when it's earned, regardless of whether or not you've received payment for it. By the same token, you get to deduct expenses, regardless of whether you pay those balances, as long as you've incurred that expense. You owe it to somebody. So with some entities, you're not allowed to use the cash basis method, or you may have to jump through several hoops just to be able to use that method of accounting. And a lot of times for a small business, the cash basis method is very preferable because, again, if they're operating, picture somebody starting their business out of their garage or out of their home office, you know, they don't want to be taking items in income that they're not receiving cash on. So it makes it difficult to pay the taxes associated with an income when you haven't received it yet. So that could be a significant factor for some businesses. Another factor that will need to be considered in your choice of a business entity is the distribution of cash. What are the tax consequences if I pull cash from the business? Am I going to be paying taxes on that distribution? That's another very important factor to consider. Another very important factor are the distributions of appreciated property. Let's say you put property in a business and it's real estate, and 4 or 5 years down the road you decide, well, you've got an alternative use for that property. And all you want to do, you don't want to sell the property, you want to keep it, but all you want to do is pull it out of that business entity and use it someplace else. Well, if you're in the wrong entity structure, you pull that real estate out and you have to recognize a gain on the difference between the value of that property when you pull it out and its original cost basis. So that could be a situation where you're paying taxes and not receiving cash. By the same token, if you're in the proper entity, you can pull that out, then there would be no real issue that you'd be facing immediately from a tax perspective. Another important consideration are self-employment taxes. Self-employment taxes can be, or really what self-employment taxes are, take the place of the Social Security tax and the Medicare tax that an employee pays. Most people, when they get a paycheck, when you work for a company, you have the employee's share of the Social Security tax and Medicare tax withheld from your paycheck. And the employer, they pay the employer's portion of the Social Security tax and the Medicare tax as well. Altogether, that's about 15.2% in overall taxes is being paid in between the combination of the employee and the employer. If you're self-employed and you incur self-employment taxes, well then you're paying the employee's share and the employer's share of the Social Security and Medicare taxes. And so we'll talk about some entities that and how they relate to that tax. That is one that can sneak up on people sometimes. Also, another important factor is fringe benefits. When I talk about fringe benefits, I'm talking about health insurance, participation in a cafeteria plan, qualified pension plans. Those things are very important, and what you're allowed to do in different entities varies. Then also the tax year is another consideration you see quite a bit. Most of us as individuals, we're filing tax returns on a calendar year. But some entities are allowed, just by the very nature of the entity that they're allowed to select what's called a fiscal year. It can be a June 30th or September 30th, whatever works best for that business. And you may wonder, well, Miles, why would somebody want a fiscal year? Well, some businesses are very seasonal in nature, and during the time where they would normally be filing an income tax return, they may be going great guns. They may not really have time to focus on pulling the information together to prepare their tax return. So if they're kind of seasonal, they can set up their fiscal year to where their fiscal year follows their busiest time of the year, and it's not overlapping with the tax reporting requirements. So again, those are some of the factors that need to be considered. So now let's take a moment and just walk through those 5 general types that I mentioned just a moment ago. The first is the sole proprietorship, and the sole proprietorship is the simplest form of a business entity that you could really have out there. It's owned and operated by one individual or a married couple. So there's not a lot of people that are involved with it. It's very simple to do. There is not a separate legal entity under the law for sole proprietorship. So it's really, because it's not a separate legal entity that's housing this business, it's really an extension of that individual, rather than it being a separate entity altogether. The owner has possession of the assets and is responsible for the liabilities. So you'll see in just a moment that that can cause a little bit of a problem there. The income or loss is combined with other individual income for tax purposes. So if I'm a sole proprietorship, I'm going to report on Schedule C on my 1040. I'm going to report all of my income. I'm going to report all of my expenses related to my business activity. And then whatever is left over after I subtract that, it's going to be my net profit from a tax perspective associated with that business activity. And then that's going to roll forward from Schedule C to page 1 of my income tax return. And in addition, I'll have other income. If I have a job, I have W-2 wages, that'll be included in there. My spouse's income might be in there, interest or dividends, any other type of income. It's all included together there. And then not only, when you report that on your income tax return, not only are you as the sole proprietor, not only are you paying the taxes on it, the income taxes, but you're also being subject to that self-employment tax. Now, self-employment tax is going to be solely on the net taxable income from that Schedule C activity, okay? And so, again, there you're going to be paying that 15.2% plus your income tax rate. So as you can see, if you haven't really thought this through and you go out and you start up a business out of your garage and you're making some money and you think, well, I've got $100,000 profit, and you go ahead and you make plans to do something with that $100,000 and you forget, well, I've got to send 15.2% of that in for self-employment taxes, you can find yourself in a cash crunch in a hurry. So it adds up, the taxes with a sole proprietorship here. Like I said earlier, it's the easiest to own and operate, but the biggest issue of all here is there's no personal liability protection. If you have a sole proprietorship, like I said, it's an extension of you. So if there's a claim against this business, the business entity or the individual with that claim against you, they have access to all your personal assets. All of those can be used to pay that claim, or be required to be used to pay that claim. So it's very, very important. This is not a business structure that I would recommend at all. The only time I think that may be appropriate if you're a young boy with a paper route riding a bicycle. It could be an adult riding down the road throwing out the newspapers, because if you have a car accident or something, somebody could have a claim against you there. And then again, all your personal assets are exposed. So it's very important that if you go this route, it's got to be something very conservative in nature, where there's not a lot of debt involved, and where there's not a lot of risk for somebody not to have a claim against you, some type of suit or something of that nature. So be very cautious before moving into this. And we'll talk about another entity in just a minute that will give us very similar results to this as far on the simplicity side, but will give us that limited liability protection. So this is one that I would very rarely recommend or encourage somebody to consider. Next are partnerships. Partnerships, their name implies you've got two or more owners in a partnership. You can't have one partner in a partnership. And there are really two basic legal forms: a general partnership or a limited partnership. There's some offshoots of that, a limited liability partnership and a LLP. We'll stay away from those. No need to get involved in that discussion today. But even a LLP, it's a limited partnership itself there. And with either one of these partnerships, a general partnership or limited partnership, there has to be at least one general partner. A general partner is a person that's actively involved in the business. If you've got a limited partner in a partnership, that person is there really primarily as an investor. They're not really involved in the business, so their activity, as far as the business is concerned, is very, very limited. Limited partners have liability protection. So now we see with a sole proprietorship, we saw there's no liability protection. Here with a limited partnership, a limited partner will have that protection. However, a general partner does not have that liability protection. The duties of the partners and allocation of income are determined by the partnership agreement. This makes a partnership very flexible. The partnership agreement determines how income is going to be allocated. So there's a lot, if 3 or 4 of us in this room, if we form a partnership, we can agree as to how that income, we may all put in the same amount of money into the partnership, but we may decide that the income should be allocated differently. Maybe I'm not involved in the business at all on a day-to-day basis, or maybe I work 4 hours a week and there's somebody else working 40. Well, certainly that person that's putting in more of the effort, they may deserve more of the share of the pie than I do. So you've got a lot of flexibility with a partnership there. Now, and when that income has been allocated, it can be allocated in the partnership agreement. Also, you can have what's called guaranteed payments. If I'm working a consistent amount of hours within the partnership, and the partnership wants to pay me for those hours, they can pay me what's called guaranteed payments. And then the excess profits, and we split based upon however the partnership agreement provides for that to be done. Then next we have taxable income or loss is reported by the partners. So just like with a sole proprietorship, the taxes are going to be paid by the partners within that partnership. They actually will receive a K-1 from the partnership that will tell them their portion of the income that should be reported on their income tax return. The IRS and the state government as well, they're receiving a copy of that K-1, and they're going to be looking for it to be reported on your personal income tax return. And again, there too, you can have self-employment taxes can be pertinent to a general partner. Now, if you're a limited partner and not actively involved in the business, you'll be subject to income taxes, but not self-employment taxes. But if you are a general partner and actively involved in the business, just like with a sole proprietorship, you've got both income taxes and self-employment tax considerations there. Okay, let's take a look now at a corporation. Now, a corporation is probably, of the entities we're going to talk about today, it's probably the most complex of all of the entities. And you know, corporations, as you see out there, if you see something with Inc., INC behind its name, it means it's incorporated. It's a corporation. It's a separate legal entity under state law. And usually you have multiple shareholders involved. And you know as well as I do with a corporation, you can have large publicly traded corporations with untold numbers of stockholders. And then you can also have one person that owns all of the shares in a closely held company. You kind of run the spectrum there. Shareholders are generally protected from liabilities of the business, so that's very important that you know they're protected from liabilities. If I go out and buy some shares of Coca-Cola and Coca-Cola cannot satisfy one of its liabilities, I know they can't come after me for that. It works the same way with a smaller corporation as well. However, it's important to note that in a lot of your closely held businesses, in particular as they incur debt, they may be asked, the shareholders may be asked to guarantee the indebtedness to the financial institution. That's not uncommon at all. And so in those instances, you'd be responsible in the event the corporation cannot repay that debt. You as a shareholder would be responsible for that. However, if there was some other claim, some lawsuit or something, and you came out on the wrong end of that lawsuit, as a corporation, if the corporation is the party being sued, then the assets that would be required to be used to fund the payment to the plaintiff would be limited to those assets that are within the corporation. So it's very important to realize that you've got that liability protection with the corporation. Another very important aspect of a corporation is it allows for the raising of additional capital as needed. You can issue additional stock. Again, as your company grows, if you believe, your business could, even as it takes off one day, could even go public. And having that corporation might allow for that to happen, and will allow for the additional investors to come on board there without changing the organization of your business. It can provide for efficient ownership transfer among shareholders of the business. If I have a few shares and I want to sell to another shareholder or somebody that's not a shareholder, I can do that as long as there are not limitations in the organizational documents that limit my transferability. There are things that you can build in if you decide, hey, I want to be a corporation, my business needs to be a corporation, but I'm not so hot about the idea of somebody owning some stock and selling it to another party that I might not want them to be involved with my business whatsoever. I'm concerned about that. You can have limited transferability of that stock or other agreements that will limit that from being able to happen. The business, rather than its shareholders, is responsible for paying income taxes. This is a big difference from what we've seen so far with sole proprietorships and partnerships, is this entity pays the taxes. Again, if I'm a shareholder of Coca-Cola, I may receive dividends. Those dividends are taxable, but I'm not paying the income taxes on earnings that are made by Coca-Cola. Coca-Cola pays those taxes, and then will turn around and they may pay dividends to its shareholders based upon the income that's left after taxes are being paid. So that is a significant difference between the corporation and the other two entities we've seen already. Then you have, here in this case, a negative here is that the income can be subject to double taxation. Again, because we are being taxed at the corporate level. Follow the example I said just a moment ago. Coca-Cola pays income taxes based upon the profits it has within its corporation. It then pays dividends to me, and I'm paying taxes on that. So you have double taxation there. You can also have double taxation when you look to sell your business in the future. And many times when we're forming our businesses, we don't stop to think about that long term when we might be selling the business. But typically, when somebody wants to buy a business, they want to buy the assets of the business. They normally don't want to buy the stock in the business, and that's a subject of discussion for another day as to what the motivation is for that. But if you're selling the assets within a C corporation, then what you've got to realize, and you're going to sell your business and you're going to go and retire, you've got to realize that the corporation is going to pay a tax based upon the gain from selling its assets. Then when it distributes those funds to you as you shut your business down, you're paying taxes again. So double taxation can be a negative, or is a negative as it relates to C corporations. Obviously, if your corporation is going to continue, you have plans for your corporation to continue into perpetuity, to go public and what have you, there's not much of an issue there in that regard. There are no, another negative there is there's no preferable rates for capital gains. We're all aware that individuals are taxed lower on capital gain transactions, sales of stock and real estate that we've had on a long-term basis we may have invested in, and we sell those to get a lower tax rate. There's all one tax rate for corporations. And there are ongoing formalities that are required with a corporation. You have the requirements to have stock certificates issued. You have the requirements to have stockholders meetings and minutes of meetings. I have some clients that may own 100% of the stock. Maybe the only stockholder, the only person on the board of directors. Still, every year they'll have a board of directors meeting, and they'll take minutes. They'll document it just themselves in the room, and they'll document what's happening there. It's really kind of a double-edged sword. It'd be aggravating to have all this additional administrative aspects to it, but also can be beneficial because having those minutes, it establishes intent. If the IRS comes in and is looking at your business and says, well, you need to pay out some dividends, and the company's just accumulating too much income and not paying it out because they don't want to pay the taxes on the dividends. If you've documented in your minutes that you've got a business plan for and a need to accumulate that kind of cash in there, then that's something that's in your favor. So it can be very helpful to you to have those minutes. And then owners who are employees are afforded a greater range of fringe benefits. And again, that's talking about health insurance and cafeteria plans, etc. S corporations. S corporation is a variation of corporation. It's called S corporation out of the name of subchapter S. It's created by subchapter S of the Internal Revenue Code. Here, the shareholders report income or loss on their personal tax returns, so there's no double taxation. So still a corporation, you got your corporate shield, but there's no double taxation. Shareholders are generally protected from liabilities of the business as a corporate shield I just mentioned. All shareholders must consent to the S election. So if you've got one shareholder that says, I don't want to be an S corporation, then that won't work. There are also limitations as far as the number of shareholders you can have. You can't have more than 100 shareholders. And something to be aware of is there are certain events that might trigger the loss of your S status. If you've got the wrong types of shareholders, there are certain trusts and other entities that aren't allowed to be able to be shareholders of an S corporation. If somebody wills their interest in the stock to a non-qualified shareholder, you can lose the S election. When that means you're back looking at double taxation and looking at those issues. Also, if distributions, as you're making distributions of profits, if they're not being made proportionate to their ownership interest, that's another reason that the IRS can use to come in and bust up your S election and make you become a corporation. And it's not preferable for highly leveraged ventures. If there's a lot of debt involved, that's generally not a good structure to be in. That's really kind of outside the scope of today's discussion. Next, we have limited liability companies, and this has become more and more a favorite of people, but just because it's so flexible. It provides liability protection to its members. You can have one owner or multiple owners within an LLC. And like I mentioned, you've got a lot of flexibility when it comes to taxation. A limited liability company is not recognized by the IRS as a specific type of entity for reporting purposes. There's not a tax return that an LLC is prescribed to file. Instead, if an LLC has an option, it can elect to be taxed as a corporation. If it's taxed as a corporation, then it can turn around and file the corporate return and pay those taxes there at the corporate level, or it can then also file an S election. So you can be an LLC, elect to be taxed as a corporation, and make an S election. So you've got a lot of flexibility. But Miles, why in the world would you want to do that? Why don't you just be a corporation? Well, remember all that record keeping I mentioned just a moment ago? And it's a lot more structures, a little more costs associated with a corporation. So that might be a reason why you might want to go an LLC route and elect to be taxed as a corporation. If an LLC does not elect to be taxed as a corporation, then it's taxed as a partnership. And that's usually what I see out there. There's very few of the LLCs that elect to be taxed as a partnership. So again, that gets them back in the partnership rules with lots of flexibility on income allocation and things of that nature. Now, I mentioned also that you can have one member of an LLC, and I also mentioned as well that that it's impossible to be a partnership with just one partner. So if you have a one-member LLC and they do not elect to be taxed as a corporation, then it's treated as a sole proprietorship if it's owned by an individual. It's really what we call it, it's considered a disregarded entity. You pretend like it's not even there. Whoever owns the LLC reports it on their income tax return. So if I'm an individual, I'm going to report it on Schedule C on my income tax return. If I'm a corporation and I have a single member LLC, it's just going to be reported on my Form 1120. So there's a lot of flexibility there. You have an unlimited number of members there. It's not as costly to set up as a corporation. It's not as formal as a corporation. We've already kind of touched on that a little bit. But it's not as flexible as a corporation in regards to transferability of ownership interest. You know, again, that's one of the big takeaways on the corporation is transferring that ownership interest and allowing additional investors into the mix there. So, which entity is the best choice for your business? I know we've been through quite a few already, but as you can see, there are a number of different considerations that have to be considered here. And establishing the proper business entity really takes planning on your part. You really have to have good vision, not just short-term vision, but good long-term vision for your business. You need to look at your plans for initial capitalization, the need to bring in additional investors or to raise capital. You need to anticipate expected levels of taxable income. We need to have reasonable levels of compensation paid to owners, and the importance of fringe benefits, as well as succession planning. Again, as many times when somebody's starting a business, they're not thinking about their exit strategy. And so thinking about your exit strategy on the business can help you choose the right entity. And some of the structures that you might even come up with that might be best for your business may involve multiple entities. Like for instance, you may set up one business to house your entity, and you may have another you may set up one entity to house your business operations. You may have another entity you may use that might own the real estate, and maybe the real estate is leased to the business. You can also have a lot of single-member LLCs set up under one corporation to give more liability protection between them. So, and have all common ownership of a corporation. So you see, these things are important. They're very complicated matters, and it is important to make sure that you seek proper counsel in that regard. But what I hope the takeaway is from here that we have some ideas as to what might be the benefits of a business entity for us, and to have us a little bit more prepared when we go to make that decision and we pull in the professionals that are going to help us make this decision. With that, I'll be glad to take any questions if there are any at this point.
Miles, my wife's a freelance artist and has an Etsy shop. And there's revenue and, of course, expenditure on our part. Largely is a lot of expenditure.
I understand.
Does it make sense to explore sole proprietorship or some type of limited corporation for that?
I definitely would. I presume that right now that she's probably, if she hasn't set up anything, she would be treated as a sole proprietorship. And so it would be reported on Schedule C. So right now, she doesn't have any liability protection. Like I said earlier, the business is an extension of her. So if there's some type of claim associated with the business, and it's not very likely in what she's doing, but there is some kind of claim, then the assets of the family are exposed there. So I would suggest, at a minimum, giving some strong consideration to a single-member LLC. You'll have to get the organization set up and then pay a little registration fee to the state of Georgia each year, but it's worth it to have that corporate shield up there, and it'll be reported just like it's being reported now, so it shouldn't come with any reporting hassles there. Any other questions or comments? Well, Bill, once again, thank you to you and your committee and Albany Tech. Oh, I'm sorry, we
I
had to go one more.
I just have one quick comment because I get this question a lot, and so if someone wanted to set up an LLC, a corporation, there of course are a bunch of steps that they would have to take in setting up a board. Is that right? I remember reading something about.
Well, it can be as complex as you make it out to be. A limited liability company is not that difficult at all to do. As a matter of fact, even a corporation, if there's only going to be one owner, certainly if it's going to be a larger corporation with more shareholders, you'll probably have more of a diverse group on a board. But then also you can have, if you've got, it could be to the other extreme where you have one person. You could walk out of here today and go form a corporation. You've decided that a corporation is right for your business. You can go see an attorney and they will walk you through the steps, and you could be the sole shareholder, the sole person on your board of directors, and the sole officer within the company. So it can be very expansive where you bring in a lot of people and having a diverse board and that type of thing, but if you're the sole owner, do you really need that? Probably not. And typically, your board of directors want to be compensated as well. So if you're the person that has just one owner of a business and you're setting up a corporation as your vehicle, there's going to need to jump through all those extensive hoops.
Will they need to see an accountant or an attorney first?
I'll recommend that you see both. That's kind of what comes first, the chicken or the egg. I personally like, of course you're talking to a CPA here, I personally like to talk with somebody first and then they go see the attorney from there. And what I always tell them is this is my advice as far as taxes are concerned from a tax professional, but there may be some other reasons why they might suggest something different. So I'll give them, this is what I would suggest, go talk to your attorney, and then y'all pull me in if y'all think we might need to do something alternatively to what I've suggested. So, but you can't go wrong either way.
Thank you.
All right, if there are no further questions, Bill, thank you very much.
Well, thank you, Miles. I really appreciate that. That was a very thorough analysis on choosing a business entity. That was great. Thank you. Also, thank you to the Albany Technical College again for the use of this beautiful boardroom and the partnership on producing this seminar for today. We really do appreciate it. We appreciate your partnership. Tomorrow, we're back here at the Albany Technical College in this very same boardroom for another course called Hackers, Cyberpunks, and Thieves: How to Prevent Corporate Identity. So we look forward to seeing you tomorrow, and I hope you all have a great day.
Bill.
Thank you.